Hey guys, this is Daniel, co-founder of FinanceMate. And if you have been thinking about investing in real estate in Germany, then this video is gonna be for you because I am going to record a masterclass that's roughly gonna be about 90 minutes to maybe 2 hours, 2.5 hours. I haven't really scripted most of it, just a rough outline. So let's see how carried away I will get. But I'll obviously put the chapters down below. So really treat this one as a source that you can come back to and keep learning whenever this topic comes up for you, or share it with your friends and discuss it. I'm trying to cover as much as I can. We're gonna go into some sort of presentation mode. I have a whiteboard that I prepared. And we're also gonna use the calculators within the FinanceMate app. I have a demo account with me where we're gonna evaluate a real property deal or multiple actually, and really see how everything works from tax benefits, from appreciation and financing, everything. Yeah. And yeah, quickly about FinanceMate. If you have never heard about us, or you just want to know a bit more about us, I'm going to share my screen now to give you a little intro, and you can skip that later on if you want to, but might be interesting for some. So here we go. Basically, FinanceMate, how we see ourselves is we're the in-between you guys who might be watching, which is sort of like the buyer side, right? You're interested in buying real estate at some point. And the seller side, which in our case is a bit special than maybe what you know from ImmoScout or whatever. More in depth on that later, but essentially developers. So companies that build properties for a living, and we're sort of in the in between, really, really helping you to know which deal. A lot of people say in real estate, call them deals. I mean, essentially, which property you want to buy. We do a lot of education upfront, aka this one. We really qualify also on both sides, you guys, yeah, and on the other side, the developers, because also maybe if you're from Berlin or other areas in Germany, you've maybe heard that um, developers went bankrupt while they were building it. So it's for us a very, very important thing to really vet the, the developers as well. My co-founder Kareem was in that situation. For example, he bought a place in Berlin in 2019, and then the developer went bankrupt and everything got delayed by 1.5 years. So that's obviously something that we want to avoid. And yeah, so that goes for both sides. And we really see it as a win-win situation, because on the one side, most people just don't know how it works. It's very complex, especially if you're an international living in Germany and maybe you're not so fluent in German, or you just don't want to deal with it, right? So that's one side. For the people that care about Venn diagrams, this is sort of how I would do it for you. We also just have, in my opinion, the most sophisticated platform for any sort of stress testing your deals or stress testing your investments. Meaning that you can really run every scenario, and we will do that live here in the masterclass further down the road once we've actually explained how it works. But what do I mean with stress testing? It's about what happens if I lose my income, aka my job? What happens if I want to leave Germany? What happens then? What happens if so many ifs, right? Obviously, buying real estate is such an important financial decision in your life. So the more you can stress test your worst case scenarios, your life better than anyone else. So whatever you think might happen to you or your situation, we want you to be able to stress test this and instill as much confidence into the numbers as we can. Okay. So where real estate actually, like, where does it fit, right? Because there's a lot of questions we also obviously get in terms of like, oh, wow, when should I care about it? Is it really for me? Like, I just want to do ETFs and it's so much easier and so on and so forth. So it's really important for me that, and again, like in this presentation, I'll use a lot of sort of these types of visualizations to simplify concepts and to illustrate my thinking, or FinanceMate our thinking behind this. Yeah, so real estate is really just one piece, but it can it can be a very important piece in building your wealth in Germany, and all of the intricacies we'll get into. But if you have no foundation, you have no protection, meaning some insurances maybe, or like a emergency fund in any case happens. And maybe if you've never ever, thought about investing, then maybe real estate is not the best thing to start with. Yeah, I'm just gonna get that out of the way. I'm not trying to sell you anything here. This is just education. In the end of the day, you need to know for yourself. We're all adults here. But that's just my way of looking at it. So obviously, maybe for those of you who have ETFs, it's also not necessarily a either or situation. It can easily be both at the same time. So also just to get that out of the way. And at the same time, it's also something that should probably be looked at. Again, this is to looking at it, not to make a decision immediately, to be looked at for your personal financial future, before you're trying to hack anything. I don't know, putting your ETFs into some sort of wild structure, and trying to find like very weird schemes. That's just my personal opinion. But if you have some sort of base, you have good income, you have like the foundation there, then it's definitely something worth checking out. Yeah. Um, and why is it worth checking out? Because you can actually build some serious wealth here. Why? Because there is multiple levers. And I hope you can read this, but you should. There is multiple levers to this. Again, don't nail me on these exact numbers. This is an illustration. But if you have your money in just a normal savings account, then you might get today, I don't know, 2%, if even in Germany, maybe 1.5. Maybe there are some people that give you 3, but that's sort of capped. And with inflation around that or a bit higher, you're basically just gonna be never actually making money. You're just like trying to sort of not lose the money that you already made, right? And if you do ETFs have some sort of what most people assume or why they get into it, right? They have like a yearly appreciation, let's say 7%, 6%, depending on how conservative you are. Some people might think they can get more, 10%, okay, whatever, right? But real estate works differently because you have a tenant. There will be a loan, aka leverage. So you're not actually investing 500,000 euros, but you're investing a fraction of that, and the rest of the money is provided by the bank, right? I guess that is very clear, but what's often not so clear here is that when that property appreciates in value, then the appreciation of, and it's often lower than with ETFs, right? So like it's not 6-7%. It's often like maybe 1% or 2%. Maybe in some areas of growth, maybe top ones, top A cities as they call it, like in Germany, Berlin, Frankfurt, Munich, you have maybe 3% or even higher. I'm even not so sure about those numbers or what the latest numbers are. I'm sure if you Google it, you'll find something on ImmoScout that gives you an indication. But it's also not a speculative. It's not necessarily, or how we see it at FinanceMate also, it's not that you speculate on the value that much, because even a 2% increase on a 500,000 euro worth property is already 10K. So if you invest, or like here, if you invest 45K, let's say 50K, and you make your 7%, then that's 3,500 euros, right? But if you, with 7%, if you have 2%, then on 500K, you already have much more than that. And obviously, compound interest, I think if you've watched until here, you probably know what this is. Then this just compounds and compounds and compounds, right? So these 2% on 500K is just much more, especially over time, than 7% on ETFs. Yeah. And the other thing here I want to mention is, again, this is illustrative, but what happens often, what we get is, okay, then I'll just like buy leveraged ETFs, right? Because then I can have 7% on my leverage. Don't nail me on this. I'm also no financial advisor, right? But and there's videos explaining this in utmost detail. Don't want to have a deep dive here. But the mechanics are very, very different if you think of leverage in an ETF and leverage on a property, right? And I just want to really, really, if you take one thing away from this, without going too deep in, is that they are very different things and they work very differently. If you buy, for example, if you go to, I don't know, Trade Republic, whatever, they have like a 3x leveraged ETF. These work very differently. They buy and sell daily sometimes. And that's leverage. If the market goes down even a little bit, you always have to make more than, like, let's say if you lose, the market goes down 10% in a day, you cannot make just 10% the next day and you're back on track, right? You actually have to do much more than that. So it can go into this downward spiral until something happens called margin call, where you actually don't have any money left. And obviously with the property, there's an asset behind it that even if it just doesn't appreciate at all, it will roughly stay at the same value, right? So that's just one takeaway here. Yeah. And now in terms of, is this really for you? I just built like a simple sort of like a flow diagram. I think makes sense. So if basically answering if you should be watching this, or if you should be evaluating property as an investment for you. So question number one is, do you have a stable income for the next 5 years? If no, then maybe there's a better foundation to be built first. If yes, the next question is, are you staying in Germany for the next 5 years? If no, then honestly, you could probably stop watching this video. If you think you're not going to be here, but end up being here, that's a different story. I have many friends in Berlin who said, oh yeah, I wanted to leave 5 years ago, but now it's been their 12th year here. So that's up to you to decide. Yeah. But if you are planning to stay, then do you have an emergency fund? Can you cover your living costs for some months? Or some things that might happen. What exactly, we can go into more detail later. If no, think about it. If yes, then are you looking to actually invest in a home to live in? Or do you want something as an investment, like a real investment that you actually don't really care how it looks? And if the balcony is towards the sun or whatever it is, right? Then keep watching. If not, if you're trying to get something, if you want to try to buy something and to live in it yourself, then this is not for you. And I'm going to tell you why. Because they're actually very, very different. Yeah. In my opinion, there are two products. One's an investment and the other one's a home. Yeah. And I'm going to tell you why. So the home is really like, hey, and I get it, right? It's like a very emotional decision. Like, I want to build a family. I want to really make this my own. I want to paint the walls however I want it, when I want it. I want to furnish it the way I want to. All of this, right? But if you think about an investment, you're thinking about returns. You think about tax optimization, and you think about what I just told you about, leveraged wealth. Yeah. Which is not really the case with a home. Of course, you can eventually sell it, but the mechanics are very, very different. We'll go into that in more detail. How to choose this is rough. Yeah, this is a rough thing for me. It's obviously super personal. There is some nuances to this, I'm sure. But the important thing here is that the tax treatment is very, very different. Very different. Okay. And this is an example on how different that tax treatment is. So if you live in it, you have your rental, you have your rent income zero, obviously, because you're not renting it out, you live in it yourself. So you're essentially paying the mortgage interest, you're paying household maintenance, and you're paying repairs and improvements all out of pocket. There's nothing you can deduct from your taxes. This is very different from an investor's perspective, because if you buy a property and you rent it out, the rent income is taxable, yes. It will go onto your taxable income. We'll look into a very detailed calculation in a second. But the mortgage interest that you pay, plus the principal, by the way, principal is not included here, but it's there. The mortgage interest, by the way, is completely deductible from your taxes. And then there's something called depreciation. Depreciation is something that's often misunderstood and a bit counterintuitive. Why? Because basically what it means is there is a mechanism where the Finanzamt or the tax authorities acknowledge that the building part of your property, you often buy land and building, is something that deteriorates over time. So essentially, it's losing value over time. And that's not the market value, which most of the confusion is going, which, the appreciation of the properties, like, oh, I bought it for 500K, in 10 years, it's worth 700K. That's market appreciation. That's what the market thinks. But what the tax authorities think or say is that the building value loses value. Why? Because of weather, tear, you need to repair it, and so on and so forth. And depending on which property it is, there is a certain percentage of that building value that you can claim against your taxes. If you're more on the financial side, or if you know financials of a business, then you've heard of this before. If you buy a desk, you can claim the expense over a couple of years, for example. And other costs, for example, also property management, are also tax deductible. Yeah. So don't get too lost here with the numbers, but just keep in mind that essentially it can be exactly the same building, but it's two different universes or two different sides of a coin. Yeah. And for that, I have a whole calculation walkthrough, plus some depreciation chart that I want to show you. So this is really now looking at a example calculation on how all of this works. So purchase details, I'm just going to go here from top to bottom. So we're looking at a property that's 400,000 euros in purchase price. 50 square meters, the price per rent, the price per square meter, sorry, is 8,000 euros. I'm just taking flat numbers so we can easily follow the calculation, which means the rent per square meter would be 24 euros. The total rent is then 1,200 a month. And here is the interesting part with the building value. If you buy a property, most of the time, the building value sits somewhere between 70 and 85%. Yeah. So essentially, this one here, now 320K, is what the building's worth out of the purchase price. And it's going to be very important for different calculations. Yeah. So, and then here we have additional purchase costs. So in Germany, you have to go to the notary for this, which is quite expensive. It's usually like around 1.5% of the purchase price. So 6,000 euros. Then you have transfer tax. Yes, the tax authorities there want some money. 24, and then you have registry fee, which is basically making you the legal owner. Also rough numbers. This, for example, depends heavily on the state in Germany you're in. But that would make 400,000 not the only money you need to come up with, but also 32K. Yeah, so in total, that would be 432K. Now, if you also go with like an agent model, or if you look for an agent to help you, then they often add 3% minimum. They're often more. But this is not the FinanceMate model, so this is not what we want. We don't take any money for this, so out. We can save that one. So that means you need this and this, so 432K to buy this property. Now, financing, essentially your costs. In this case, I'm just going to go again, make it easy. I'm going to go with 100% financing. This is very much possible if you comply with certain criteria. If you're earning well, if you are a permanent resident or EU resident, and the property is good in the eyes of the bank, then that's very possible. We've also had a couple 108% financing deals in the last few months at FinanceMate, which means you can get financing, you can get all the money from this money here plus this one, so you actually don't even need equity in the beginning. Yeah. But for this example, 100%. Interest rate 4.5%. This is something that we've been seeing on the latest deals that we have. And then repayment rate is 1%. As investors, you want to sort of keep the repayment rate low to keep your cash flow in check. But more about this detail and how that works a bit later in the actual calculation. Yeah. So what that means is you have some costs. You have to pay 18,000 euros per year in interest, and you have 4,000 euros per year in repayment. And then if you are somebody who might not want to deal with the property all the time, then you are likely going to get a property management company that takes care of that. If you can probably get easily by with 1,000 euros per year on a good property management company, especially with A-tier cities. We'll more on location later. And then in terms of maintenance and repair, some people say, oh, like how much money should I put aside every year in case anything happens? This also depends highly on the property that you are buying. FinanceMate focuses mostly on new builds. I'm going to show you a slide right after that on why. But essentially so that you don't have to worry about this in the first few years. So putting all of these three together, we would come out at 23,000 euros per year, which is roughly 1,900 bucks per month. Yeah. So every month, this property with this financing would cost you 1,900 euros. Yeah. So now we're looking at income. Income is your rent. Your rent here, we said it earlier, is 1,200 per month, which is then 1,400, 400 per year. Now, if we look at that, we pay 1,900 versus 1,200. We're coming out at minus 700 euros per month. So essentially, you're paying 700 euros a month out of pocket to buy this property, which is quite a lot. Yeah. If you think about, I don't know how big your ETF savings plans are, but 700 euros a month for a property is for some a lot, for some not so much, but nonetheless, it is money that goes out. So this is where the tax benefits jump in, because tax benefits add to that calculation and they turn this subtotal towards positive or even positive. Yeah. And they are the thing to understand here, which is why I'm going to really take my time with this. I want to make sure that you really get it. Okay. So if you are employed or self-employed, you have a taxable income. That taxable income per year wants to be taxed. Well, it has to be taxed. If it wants to be taxed is a different question, but it has to be taxed, and you have to pay taxes on it. For the 100,000 euro taxable income, again, I'm taking flat numbers. You can calculate that for yourself. But let's say you earn 100K. You pay an income tax, 32,000, and that's for 2026, by the way. I use the official German calculator. I can even put the screenshot of that in here. Here we go. This is the screenshot. So you can go to this website, bnfsteuerrechner.de, and then you have your 100K, and then here is your 32,115. Yeah. Now, real estate changes your taxable income. Okay, that's important. How does it change it? Well, you have your rent, and that actually goes on top, right? So now instead of earning 100K, you earn 114K or 114 and 400. And you pay taxes on that one. So that's 6,000 more in taxes because you now have a property. But that's only the plus side. There's also a minus side, and that minus side is key. Because you can deduct, as I said earlier, your interest rate payments, which is 18,000 euros in our case, right? We said here our loan, 18,000. You can also deduct depreciation, which I explained earlier, but I want to explain in more detail right now. So we said we have 320,000 building value. Yeah, this is the 80% of the purchase price is the building value. I said something between 70 and 85 is usually the case. Now, how that works in more detail is, before we zoom in here maybe, there's essentially multiple percentages tied to different methods of depreciation. There is something that's called a linear depreciation, which is the blue line here. On an abstract level, we can already see it goes into it's a linear line. Essentially, what happens is that percentage is applied until it's 0 from 100. Meaning, if you have a 2% linear depreciation, the whole building gets depreciated over 50 years, right? 100%, 2% every year will take 50 years. If you would have 10% a year, you would do it in 10 years, right? And so on and so on. I think the math is clear. Now, the method that you can apply depends on the building type, okay? So the building type there's older buildings that have this linear depreciation. It's either 2%, 2.5%, or 3%, depending on the year. But yeah, maximum you can get 3% for them. There is new buildings that qualify for the 5% degressive depreciation. Degressive means instead of doing 5% per year, equally linearly, you have 5% on the first year, let's say for 320K, right? We can actually zoom in here. You depreciate 5%, and then instead of always going from the building value, from the start building value, right? Linear 2% always takes 320, 2% of that every single year until it's 0. Degressive takes the new book value and applies 5% again. And as you can see here, what happens is that in the early years, you depreciate much, much more in this digressive version versus the linear one. Again, don't look at the exact numbers here, but it's this curve that's interesting. So instead of waiting 50 years or waiting 20 years for depreciating 120K, you can do it in 10, in half the time. And I think that's really key. This is a very new rule. It only works for buildings that are finished between the end of 2023 and 2029. So it's a fairly new rule. It helps to basically stimulate building apartments in Germany, which is very, very necessary. Yeah. I have another slide here for the building type and sort of like why we think or why we work mostly with new builds. Okay, so here you have effort required and you have financial impact, and basically what a lot of people then get into is like, oh yeah, there's this nice Altbau, I would love to live in it myself in Berlin, Munich, wherever it is. But these old buildings, they come with a lot of downfalls. From a financial impact perspective, yeah, we're taking from an investor's mindset. They have lower depreciation. Side note, yes, there is ways to get a custom depreciation rate, which basically means you can go to authorities and to people who evaluate this property, and then you say, oh, this could maybe be depreciated, or the so-called Restnutzungsdauer, the time until it's used, sort of, is much lower than 50 years. It's, I don't know, 30 years. Then you would be at a much different rate. But it's a very tedious process. And again, you're likely in that space of you have to renovate something, you have to put a lot more capital up front, you get a less good financing deal, all of this. And with the new builds, you have this 5%. That's digressive. So you put a lot of these tax benefits into your early years, which is great. And you don't have because of the building quality in Germany, which is I've traveled a lot as well, much, much higher and much more regulated than in other countries. You have a building that's likely not going to need any bigger repairs in the next 5 to 10 years. For some buildings, there's even a 5% warranty from the developer that if anything big breaks, they're going to pay for it. Yeah. So that's just from our perspective. There's like much less effort required, much more hands off, and the financial impact is still high. So that's why we see it here. Yeah, so back to that. That's essentially the curve, and that's what we put in here. Because we're buying a new build. This is 5%. Yeah, and then we can also, to come back to this tax calculation, we can also depreciate. We can also deduct the property management costs. Yeah, because maybe a good analogy here would be that buying a property to rent it out is sort of treated as a business activity. So naturally, as a business, you can deduct expenses that are related to your income. So you're now renting it out, so you have rental income, and you can deduct expenses that are related to that. So now, instead of your taxable income being 114,000, it is 79,000. And now instead of paying 32,000 euros in taxes, you pay 22,000 euros in taxes, which means here you have tax savings in your first year of 9,870 euros. And that divided by 12 would be 822. Now, if I would take that 822 here and quickly calculate this again, we would be at 822 minus 716, 106 euros per month that we would actually get from this property. So this property, again, it's an example, but this property would be cash flow positive from month 1 or year 1. Yeah. And that's the calculation, but that calculation has one big flaw. And if you've maybe, scanned the market, or you bought some Excel sheets that give you this type of calculation, there is one big fat flaw, that it's only year 1 and it's super static, right? Obviously, you're buying real estate not to be selling it next year, but you're buying it to hold over a longer period of time. And that's what needs to be evaluated. You cannot only look at year 1. And this is where we built FinanceMate, or let's say this is one part of FinanceMate, but this is why we build out the property feature so much. Yeah, this because to make long-term financial decisions, you cannot just only look at year 1. You need to be able to look at as many years as you want to look at and project it into the future. Yeah. So this is what we're going to look at in a second. I plan to actually speak about the market, but the problem here is that, or at least the philosophy that we have, is that there is a lot of people out there that are trying to find very speculative real estate investments. Oh yeah, if you buy in the outskirts of this and this city, it will grow massively. Everyone will move there into the suburbs, this and that, and beautiful stories. But it's really not where the math needs to make the most sense. As you just saw in this calculation, yeah, because they say, Leipzig has better rental yield. It has like really high appreciation. The market grew there massively, and so on and so forth, right? But this is not necessarily your number one priority. your number one priority should be the micro location. The micro location, I'm just gonna write it here. The micro location of the property and the tenant profile. These two things are, again, you can make your own opinion, but these two things are so much more important to me. Because why? I'm going to tell you why. So, tenant profile. If I'm going to buy something that is super far outside of a city or in a random village, it's much less likely to find good tenants, right? If I then buy something that is maybe like 300 to 400K, which is often sort of a range that people go for if they start, then you often get something between 80 and 100 square meters. And this is outskirts, right? This is outskirts. Now, who actually moves into outskirts and this type of property? It's often families that might stay there for a while. Now, the problem with that is, again, we're purely investor mind focused. This is nothing against anyone or any family profile that you choose. But just from an investor's perspective, this is not your most lucrative or most wanted tenant profile, in my opinion. The really good tenant profile is a young professional couple. And maybe you are in a young professional couple setup watching this, or you are a high earning young professional, right? Then you often move to big cities. You often move to big cities into apartments that are between 50 and 70 square meters. Yeah. And you're not going to stay there forever, which means there will be some turnover in tenants every couple years. It's not going to be every year, very likely, unless the couple starts making a lot of money suddenly and is like, we need a bigger place or take a family, sure. But look at your friends, look at yourself, maybe me included. I'm more on the upper this side at the moment, but I'm in it for 4 years and I have a 2% increase on my rent every single year, right? If you are somewhere in the outskirts, and my property, if I'm going to put this property or that my landlord puts this property onto the market here in Berlin, it's going to be rented out within a week, right? If you're in the super outskirts, and you can choose whoever you think has the best financial profile or the best human profile that you want for your apartment, you can choose. And this is very, it gets harder and harder the further you move into places where there is not, where there is different types of tenant profiles. Yeah. So maybe a little off script. I told in the beginning that I don't really have one. So except these slides that I prepared, but this is just something to really think about. And then micro location. The micro location also just matters a lot, yeah, in terms of like what are the actual prices. But this is such an undervalued part of being an investor. We're not talking about huge investors that buy like 50 properties a year and they have like these big family homes or whatever, or multi apartment buildings, stuff like this. So as if you're maybe buying your first property, then good experiences also matter. So tenant profile is important. Okay, let's come back to the 1 year super static, being super static, and you need to be able to look at the longer term picture. That's the main point, right? And in here, I'm just having some cases that you need to think about when you get into this, right? And this is really something that should matter to you. A resilient deal, this fancy word deal, but a resilient deal survives 2 to 3 of these scenarios at once. Yeah, which means your income can drop, and it can drop unexpectedly because you were being laid off or whatever it is, yeah. Or some other big expenses come up, whatever it is, yeah. But it can also be not forced and can be voluntary because you're like, you know what? I just want to travel. Next year, I've had my run at this company. I did a few solid years. I'm ready to take a longer break. I want to do a sabbatical. And now, what most of fancy Instagram real estate people tell you, oh, never get a mortgage because then you can never travel, you can never change jobs, you can never do this, whatever. It's just numbers in the end, right? And if you think you want to do a 12-month, 24-month, 6-month, whatever it is, long sabbatical, then you should just try and plan it and stress test this property that you're about to buy against it. And you know best, as I said earlier, when you might want to do that. Is that next year, basically, maybe, if you think about buying right now, in your first year of renting something out, in your second year, after 5 years, whatever it is. But just plan it beforehand and you can do that. That's my whole point. The second thing is obviously something that a lot of people worry about when they get into this. Or what happens if my tenant doesn't pay or if I don't find a new one, right? If the tenant doesn't pay, there's insurances for that are also not really expensive and even tax deductible. Yeah. But vacancy is why I also just spent 5 minutes babbling about the tenant profile. Because if you go for micro locations or even just big cities that have lots of rental demand, then with good planning and being on top of things, or having a Hausverwaltung that's also on top of things, then this is not going to be the biggest problem, right? That's just how it is. If you know any landlord in a tier 1 city in Germany, Frankfurt, Munich, Berlin, Hamburg, whatever it is, and they've had a 6-month vacancy because they can't find a tenant, I'd be very surprised. Anyways, next one is one big risk as well is sort of the refinancing, right? And I'm sorry for the German English mix here. But basically you're refinancing after a fixed term of your contract, and whatever you sort of need to take whatever financing interest rate there is at the time of market, which is a big problem at the moment because there's a lot of people that bought in a very low interest rate environment, aka a couple of years ago, where it was 1%, maximum 2%, even lower. And now they're like, okay, I need to refinance my loan. And now it comes to sort of like 4.5, 5%. And it can obviously also increase. Yeah, so that's just something that you also need to model or think about. But if you're an investor compared to being a homeowner, this is also not that big of a deal because you as an investor compared to a homeowner can deduct the interest rate from taxes, right? So this is bothering you less. Now, this one is just like a repair thing. Again, this is also sort of like why it might make sense to go for new builds with like less chance of bigger costs. And then, I mean, one scenario that can also happen, right? Because we can also be positive sometimes, not always be negative, is that income jumps. You can get a big career upgrades. You can change jobs and get a better offer, all of that. And then also what happens, right? What happens to that scenario? If your income jumps, that can maybe also mean now suddenly the property is even more worth it because you can deduct even more taxes. Or, it might make sense to get a second one, like stuff like this. This is just some financing thing. Some information around who is eligible for financing. If you are, as I said earlier, sort of an EU citizen or you have a permanent residence, then depending on the deal, very important, depending on the property, 90 to 110%, 108, 106, it always depends. These are terms that you use when you also finance the upfront costs. And these can be sometimes 6%, sometimes 8, sometimes 10. So, then you can basically get everything paid for. A little bit less fortunate is blue card holders with a permanent contract. Again, some people say it's possible. It really depends on the deal, but it also depends on the banks. I would say if you're here, should be fairly easy. If you're here, maybe not. Yeah. Okay. Another very important topic to mention, which is also what you probably see on Instagram a lot, is the 10-year property cliff. Yeah. What it means, again, don't look at the numbers, but what it means is it's illustration here. After 10 years holding the property, you can sell it without paying tax on the gains. Very little assets have that. Property is one of them. If you combine that with even low appreciations, but because it's leveraged, we talked about it earlier, then this can be very, very lucrative for you. Is selling always the best option? Depends. But if you have the option, it can be obviously great if you don't pay any taxes on it. Yeah. So it's a very, very important concept to actually understand. Is you have your income, yeah, and you're being taxed on it. And then you invest in ETFs, for example, yeah, and then you are taxed again on these ETF gains, right? With property, this is different. You have your income, you're being taxed, you buy property, you get taxes back. And then you sell it, and you're not taxed. Yeah. So this very scrappy diagram shows you how important taxes are in your financial investment decisions. I'm also not a licensed tax advisor, just to say that, but very, very important. So now let's go back though. I have been suspensing it for a long time. And let's actually have a look at the FinanceMate dashboard, and let's look at some real deals. So here we go. This is what I used earlier. Here we are in the FinanceMate dashboard. You can create your account for free. You can also bring your own property and add it, yeah, or you can find one with us. But if you are, for example, looking at something from ImmoScout or anywhere else, then you can just use our features completely for free to evaluate it. Just to have put that out there. So what do I see here in the FinanceMate account? I have 3 properties in sort of my portfolio. This is stuff that I have assigned in my demo account here. And one something in, these are real properties. One is in Wiesbaden, one is in Frankfurt, and one is in Berlin. Now, the way FinanceMate works also in terms of properties is that we, through our partner network, have access to off-market properties, so you will not find these anywhere. And we have all the details to be able to calculate what's important. Yeah. We can look at them all 3. I'm going to show you some different features, but I really want to sort of show you how these calculations work, yeah, in the broader context. So this is just some views. You have some metrics. You can watch some videos, but I'm just going to skip this. I'm going to go to the proper investment analysis page. Price here was 466. Size, build, location is Wiesbaden. Wiesbaden, I would maybe not call the top A, but it's like 8.2 because it's actually a very important city there by the Rhine. It's just it's less known. There's a lot of industry there, like a lot of German hidden champions. So yeah, and it's the capital of a state, so it is a state capital. Let's look at purchase costs. Purchase costs, we had notary 7K, land registry 2.3, transfer tax, right? This is what we saw earlier. Rent, what are we getting here? 1.6. And then financing, we're financing a lot of the loan. We get 500K, so we're actually financing 108%. Yeah, so we're financing this and the upfront costs, which results in a big rate here. We're financing 108%. But what I'm really interested in is now running scenarios. Yeah. And this is really where the meat is at, in my opinion. So I'm going to walk you through how we do it, or the partner does it with FinanceMate users. Once they're here, is you have your scenario inputs on the left and you have your outcomes, so to speak, on the right. Now, why does it look like this? I told you earlier about 5% degressive depreciation, but there is also, and we've seen it in here, something that's called Sonderafa. AFA is basically appreciation in German. And this allows you, there's a lot of constraints to this, but some properties have it, allows you to write off an additional 5% for the first 4 years. So per year, but for the first 4 years only. Yeah. So that's why these first 4 years are much higher in tax benefits than the others. Yeah. But let's look at this. Okay. So we have a lot of income, which I'm gonna go down immediately. So let's do 100K, 100K, and 100K, 100K. You know, we often also apply some sort of income growth rate, but since most people get a salary bump, but let's just keep it at 100 for now. Okay, so what do we see here? We have the tax benefits. we can look at them in more detail here in the tax calculation. So I have my 100K income. My rental result is negative. This is what we calculated earlier. So we have our rental income. And in this case, this property is not rented out from January. It's rented out from something in the middle, July, I guess. I haven't checked. Then I have my depreciation, which is again also for half the year. Then you have my interest payments half a year, something that's called Bauzeitzinsen, which is also another topic to cover later. And in this case, we have no other costs for now. You could add them, property management, etc. It's not going to move the needle if there is 1,000 more or less, right? But essentially that number then you will find here. And from a taxable income before to after, you reduce your taxes, right? That's the calculation we had before. And that comes then into a certain cash flow. And to really show you the incredible effects of these tax benefits, we built our cash flow chart so that you can include and exclude them. Yeah. So for this specific property, your cash flow would be positive like crazy in the first 4 years. Yeah. If I turn it off, it'd be quite negative. So this is really the power of these tax benefits. Yeah. So this is annual. We could also go monthly and say, instead of, if you didn't have the tax benefits, instead of getting almost a K, you would be losing 500 to 600. Yeah. Why is it going down? Because at the same time, we have our rent going up. So we're getting more. We have our interest rates going down. Why? Because loans in Germany are, you always pay the same amount every single year. But in the beginning, the interest is higher because it's from the full loan, right? But as soon as you start paying down the loan, the interest payments decrease, but the principal payments go up. Yeah. So here you have it. Here they start going up slightly. Yeah, you can see that while interest is going down. So, and now you say, okay, but now even with the tax benefits, everything's still sort of red here, right? But guys, look at this. This is 50, 70 bucks monthly, or 300 to 1,000 roughly that you pay for this property on top. But you've built all of this capital up front that you can just put aside, or you can use this money and put it into ETFs, right? Which is crazy. So this is just one property. And then obviously what we also have, before we go into more scenario analysis, what we have is your sales proceeds, right? So now this property is 108% financing. And after 10 years, you'd be going away with 182K. So you essentially invested nothing and you made 182 in 10 years, which is kind of crazy, but that's just how it works. Because why? We have a market appreciation. And this is really then where the scenario planning comes in. If you say the property will only appreciate 1% a year, it's still 70K. Yeah, it's not only 70K. You also made 37,000 in total over these 10 years in cash flow. So essentially you made roughly 100. Now, if we go up a bit more, obviously it goes up. We didn't include selling costs, but if you would include maybe 30K here, yeah, then deduct 30K from here. And this happens, why? Because you have a sale price and you basically pay off the rest of the loan. Now, obviously this calculation changes a lot if you change the holding period. Yeah. Let's put it, oops, that's the wrong one. Let's put it to, let's say 25 years. Yeah. So now with the market depreciation being 2%, you would have this in value. Yeah. You would have made less cash flow because here now suddenly you would have to pay more money. Why? And we're going back up again. This is a masterclass nonetheless, so I'm gonna just explain everything in more detail. Something interesting happens here, which is why this cash flow is going red. What is happening? We are at some point getting more rent, paying less interest, and have less to depreciate. So we're paying, our taxable income is rising. So with the tax benefits, we're working against a clock, basically, that at some point it will flip and we're making negative, which basically means we also have to pay taxes on what we earn. So here we also have more income, but we have the tax benefits going away, right? If I show this here, then here your cash flow would actually be positive. Yeah. So that's a very interesting phenomenon, and what essentially means that at some point it might just make sense to buy another one, right? You see a lot of people who start with one property, buy another one, and another one, and another one, and this is a great additional factor to sort of look at when a good time is to do that. But yeah, maybe you don't want to hold it forever. Let's say 15 years, right? So that's that. Now we've played with appreciation. Let's play with rent. So there is a few options that we can do here. We can say let's look at cash flow. We can increase the rent, our starting rent. We start conservatively often, right? But you can also look at market prices and see, like, look, if I would get 24 euros instead of 21, then I would actually always be positive in my cash flow. Or let's say I have my rent increase 2% per year. What some people also do is you can go 15% increase every 3 years. Whereas I said earlier with the tenant profile, if there's people moving out every 3 to 4 years and there was a market adjustments, you could also increase the rent and take that, right? And now this property would be even more profitable. Yeah. But you can also obviously also say, like, oh, look, what if there is vacancy? What if I don't find a tenant? Well, let's say there is 3 years or 2 years, for whatever reason, 2 years you get like zero rent. Nobody's living in there, right? Is it really that bad? In this scenario, let's say we go back to 20 euros a month and we don't increase the rent. Yeah. We don't increase it. We are below market and we say, like, look, year 1, 0. Or like half of that, right? 9K. Still a good picture. Or here we say, maybe here's 0. Is that too bad? You could put that money aside and have it here. Yeah. So there is lots and lots to do here to calculate different scenarios. Again, you probably do have some increases. Let's go to that one, or 10% every 3 years, right? We had it on 21 in the beginning. So now we come to financing. Financing is also an interesting one. Again, here, something that's missing still, that we're still building, is the refinancing, which is a very valid point, obviously. But if you're starting out now, this is what you should care about. Yeah. The financing is not something you can control that much. It's whatever the bank can offer you, right? You can find the best offer, going to different banks and so on and so forth. The experiences that we've made is that there is banks that know the projects really well. It's usually local banks. For example, local Frankfurt banks that know Frankfurt market really well. And then it's better than maybe going to a bank in Munich and ask for something in Frankfurt, right? But this is just to show you, or we've built this to visualize you that because we've gotten the sort of questions like, oh, but can I not negotiate my interest rate down by 0.1%, right? And this goes to show that the 0.1 or even 0.2% does not move the needle on this whole calculation, right? The 0.2% over the 10 years, if you look at this number here on top, 33K, is a 10K difference, yeah, over 10 years, which nominally speaking is a big amount, but in terms of making this decision and looking at 10 years and looking at all the other metrics, it might not be that influential, right? And now towards one of the most important features, what I said earlier about the income. So for example, we have some presets here for leaving Germany, like what happens if I leave Germany after 7 years, for example, right? If you leave Germany after 7 years, what happens? Your tax benefits go to zero. Why? Because you just don't have any income anymore, right? Essentially what we do here is we put the income to zero for all of the other years, meaning there is no income anymore. Now, if you, this went to 100K, 180 again. Let's say if you do 80K, you earn 80K, right? 80K, 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 which, if we're honest, it's probably going to grow. It's hopefully not going to stay the same, right? So maybe it's like 84, 88, 90. And there you can obviously, you know yourself best. You can be as ambitious or as conservative as you want to. But this is what this calculator or scenario planner is built for, right? Now, we look at the cash flow again. What happens, obviously, the significant thing here is the cash flow from sort of when you leave Germany, from 7 years. And what happens is, hey, look, I have here a problem with my cash flow. The question though becomes is how big is that problem? And if you look at this, so 4747, so we're at roughly 9.5, 13, and another 5, so 18K. 18K, you've made that here with this property. If you put that money aside, you can, even if you leave Germany, and we look at this picture here, even if you leave Germany, at some point the rent will catch up to the interest payments, and then you'd have a property that would actually make you money in Germany, and you could potentially sell at some point, right? But what you need to know is how much money do I need to put aside to be able to manage this, right? So now if you say, you know what, I'm going to work for another 2 years, I'm going to take a sabbatical, I'm going to have zero income, right? Boom. Okay, then you need 8K aside. And you put that with that property. Again, this one is a bit special one. Not every property has this Sonderafa. I'm cherry picking here maybe with this example, but I brought others. So we'll go through these examples one by one. But this is also manageable, right? Obviously depends on the person, but in my opinion, it is. Well, if you didn't have the tax benefits, maybe it wouldn't be so manageable, right? So this is essentially if you would, if you didn't even have rent, then that's what the home ownership looks like if you're not renting it out, right? Now, we've looked at this example a lot. Let's look at this one. So this one is a property in Frankfurt. Price per square meter, 8K, size 50. This is actually very close to the 400K example that I have showed you guys earlier. Here we have 105K income. I'm just showing you different income examples also. Maybe I can do, I'll just leave it at that. You can put your own incomes. This is just an example, right? Now, so what do we have here? Market depreciation 3%, holding period 10. Cool. We have again this declining tax savings. Why? Because we have declining depreciation, right? Every year it's going to be a bit less. Well, we see that here. Here our depreciation first year is only partial because we're starting in the middle of the year, but then it goes down because the book value of this depreciation goes down. Meanwhile, the interest rate also goes down, rental income goes up, right? So that's that. And it adjusts to the tax calculation. Income, again, here it stays the same. It is likely not going to, hopefully not for you, staying the same over 10 years, but tax savings there then go down. Yeah. And here you have quite the high rent, which then also does not create that big of a loss, which is why the tax benefits here might not be that high. Yeah. But if we look at this property, and this one is in the heart of Frankfurt, we have an annual loss here of, well, with tax benefits of 2K. Again, would be a bit more dire if we would take them out, of monthly 200 euros. Yeah. So this property, if we have 25%, 25 euros rent, I know this property. I know some customers from ours that have this property and they're renting it out for 29 right now. Right. Which would then create a cash flow of minus 62, minus 93. Like this is very, very manageable if you're at that income level, right? Now, this property, sitting in the heart of Frankfurt and being at almost 400K already, again, maybe is then more of an appreciation play, right? Just to give you a comparison between something that's maybe more cash flow oriented, something that's a bit more sales proceed oriented. Now we have one more property. We have this one, which is in Torstraße. Whoever's from Berlin knows Torstraße, I guess. This is a very crazy property. Let's have a look. I mean, it's insane. This thing costs 14,000 euros a square meter. The price is 700 for 50 square meters. It's crazy. I mean, the location cannot get more central in Berlin, cannot get more metropolitan Berlin, right? Sounds crazy. So let's have a look. Yeah. Again, this is a high income one. We can change it. Right? Maybe the target profile is more like that. But let's say you earn 90K and 92, 94, 96, 98, 100, 802. I'm just making this up on the spot, guys, by the way. So that's 10 years. Cool. Now, this will look very different. Yeah. So maybe if you are earning 90K, this one's a bit too expensive, is what I would read here. It depends. I mean, it really depends. Are you willing to pay 500 euros out of pocket per month. It might not be, yeah, or annually 5K. If you are thinking that, oh, I have this 1,000 euro ETF savings plan or 500 euro ETF savings plan, and you would compare that, maybe I would not choose to put 500 euros of ETF of money into ETFs every month, but I would put that 500 euros into this property. Then with a property that's worth 700K and you have a market appreciation of 3%, you could obviously within 10 years get away with a lot more. Yeah, if we look at 20 years, if we look at 25 years, again, we're talking about compounding it like crazy, right? Or even at 2%, even at 1%, your sales proceeds would be insane. Yeah. For what? For doing what? For putting 500 euros a month into something? Yeah. That's pretty crazy to me. So this is the point of this tool. Now here the income goes up like crazy. So let's maybe not do that. Adjust that. I just saw that because this cash flow chart here looked weird. Like whenever charts look weird, there's usually something happening. So I guess this one, right? So let's do 0. Let's do 100, 112. Let's just hope your salary increases are higher than that at that pace. 0. I'm just gonna throw in some random numbers here. 0, 200, because we're getting an executive job. 0, because we're quitting it. No, let's do a bit more than 111, 150. Done. Okay. So now cash flow looks also a lot more bleak, obviously, right? Because we also have some years where we just don't have any tax benefits. So yeah, if you would exclude them though, it would be a lot more monthly, yeah, let alone annually. 18K, 17K, do you want to pay that for a property? Maybe you do, maybe you don't, up to you. But this is what it would look like. Could still be justifiable for an appreciation play, right? Here 3%, obviously it's not going to be 6, but this location, pretty insane. Let's look 30 years. Yeah, not that bad. Now, this is just 3 properties that I wanted to show you, right? Obviously, there's a lot more, and none of them might be for you. You might want to just find your own. You might want to find one with us, but whatever it is. We have 2 more features that I want to show you here. One is the compare feature. So essentially what we built here is you can pick one or pick 2 properties that you want to compare. So I'm picking these 2. There's a few things that we flag, right? So we have this one that I showed first in Wiesbaden and the Frankfurt one. Now, there's 2 things to make it less direct. Obviously, it's hard to compare an apple to an orange. So this is what we flag. If you are comparing 2 different properties, then you also might want to know, like, hey, there's some differences there. In this case, this one just has a different depreciation method than this one, right? It has the same degressive as a base, but this one's got an additional. So it's not really fair to compare. Or it might, depends on what you actually want to go finance. But also the purchase prices are not exactly the same. This one matters a bit more in the comparison, obviously, because if you have a 2% appreciation put into your calculation, then putting that on 200,000 euros more or 100,000 euros more of value will make a difference, right? But essentially what you have here is the total return So this is your net sales proceed after tax, sell the property, plus whatever cumulative cash flow over the holding period, which means whatever cash flow this property made you will be deducted if it's negative or put on top if it's positive. All the tax savings, cash flow, right, and equity. And now you can see here also the difference in tax savings over 10 years. Yeah, so you save almost 100K in taxes. That's money that you have paid, that you will pay without a doubt, because the Finanzamt's going to get it. And with this, you can get it back. And at the same time, you can build value with it for yourself, right? So that's pretty crazy. You can compare what we say most important here to sort of decision making first-time investors. Can I afford it? Cash flow, and then also the tax impact. You can drill down here also in the whole tax calculation. So just to make sure that the incomes are the same here. So this is 120K income, right? Obviously, this stuff needs to be normalized. If one has an income of 80K and the other has an income of 200K, then that will be a very different calculation, right? So that's that. You can also, in theory, edit that. Same if I would choose here now the iconic Torstraße one, then it's very clear that you have a very, very different price in square meters, which is insane, right? It's almost double. It's more than double. And then a very different purchase price. So this is not directly affecting it, which is why it's not a warning. It's just different submarkets, right? But the purchase price obviously matters for your equity at the horizon. And here you can see that very clearly, right? Essentially, your total return here would be very different, and your tax savings would also be very different. Like, look at this. That's pretty insane. Why? Because you just have a very different purchase price. And here you have your cumulative cash flow with this property would be more positive. If you don't care about cash flow, you have a lot of cash at hand, then maybe you don't care about that cash flow so much. But if you don't have a lot of money at hand, or liquid, let's say, then you care about the cash flow much more, right? So that's essentially what you would be looking for then. Here you can also say like, okay, let's compare over a 20-year horizon. Yeah, you would get, you would save 220K in taxes. That's quite insane. I'm also seeing these numbers for the first time. So yeah, that's pretty crazy. We have some metrics here as well to evaluate. Now, some metrics are just not evaluable if you have a full financing and you don't actually invest anything upfront, right? Then it's very hard to calculate that. With this case, we actually put a little bit of equity in here. It wasn't 100% financing, which is why we do have values for B. And this is quite insane if you think about the IRR basically is what you really get out of it at the end. And it's crazy, 31%, damn. And here you have 14% annualized ROI, which is sort of like your return on equity, which is, if you would like to compare that to ETFs, that would be the number. So that's quite insane. Let's look at this Torstraße one again. Let's open the calculation. Oops, there's some pictures here from the staging. That's the one. Maybe you've seen it if you're from Berlin. Financing. Very cool. So that was the compare feature. If you have made it until this point, we're 1.5 hours in. Kudos to you. You're probably interested in this topic. Congratulations. So next one is the portfolio feature I want to show you. Portfolio feature is basically for you who maybe has a property already or multiple and is evaluating their next purchase, or somebody who is only getting started but wants to build a portfolio, aka buying more than one property. You can basically evaluate that. Here, this is the goal of this feature. Right now, I have all my three properties that you saw earlier. I have a sort of total wealth built. If I sell all of them at the same time, which is obviously not very likely to do, but you can have that however you want. You can also manage your income from here. You have the different timelines. Always also not the best example to show you in terms of, usually you buy one every year, every 2 years, something like this. But you would have everything combined: income, right, rental income, depreciation, interests, and your results, which, if you have 122 income and your rental result is 102K, then you're not paying a lot of taxes at the end of the day, which is a case that we actually have amongst FinanceMate clients, users, however you want to call it. We have helped one person buy 2 properties just back to back, more or less, because their income was roughly around this and high enough, basically, to buy 2 properties. And she, very smart lady, she is now around this for the next couple of years. So she's paying almost 0 taxes, which is, if you earn this and you're used to paying this, and then suddenly you pay this with a horizon that you make money, is kind of crazy. So yeah, we have tax benefits, again, the same charts. The most important chart, though, is this one. And this one is key in making these decisions on when to buy a next property. One of the keys, obviously, your personal financial situation, your plans, family, capital, all of this matters too. But from a pure tax perspective, this one is the chart to look at. What does it say? It says you have a gross income that's increasing, which is this line here on top, right? You're currently earning 120, you're sort of like 2% increase every year going with inflation. And then because you're buying these properties, you are decreasing your taxable income to a point where, if you would actually go below this line, you would pay 0 taxes. So if you would be all about that, then going below this line would enable you to do that. Now, if you cross the red line, then you are in the highest tax bracket, which means that every additional euro that you earn is going to cost you a lot of money in taxes, right? Marginal rate is 42%. So every additional euro you make, 42 cents are going out of your pocket. So ideally, at least stay between those 2 lines with your new taxable income after you purchase real estate, right? You can make still 200K, 100K, 80K, whatever it is. But you sort of want to stay there. So if I say now, for example, I make 100K, then this is what would happen, right? So now you would actually make a minus taxable income, which would basically then result in paying 0 taxes. Yeah. So yeah, that's possible, which I also, in that regard, did not know until a few years ago. until I got started with real estate, but that's what it is. So yeah, this chart's very important, and obviously it will be maybe a bit more spaced out if you buy things later on, or if you say like, look, I'm not buying this one, you can just filter it out, right? Then okay, my taxable income stays quite high, still much lower than before, right? You are still, I mean, the cash flow of this one was quite hectic. But if you say this is your monthly cash flow buying these two properties together, if you only buy one, then your cash flow could be like this, but having even more tax benefits with adding this one would bring your cash flow to a whole different level, which is crazy, right? Like, look at this. Tax benefits, minus 16K, boom, plus 16K because of your rental result. Insane. Bringing them back, you also have this chart here, which is your cash flow. And then at the end, you have your net thing. So you can also say, this one I want to sell after 20 years. This one I want to sell after 13. This one I want to sell after 17. We recalculate everything. You have like, hey, this one sold here, this one sold here, this one sold here, this one sold there. And you see sort of like when they are getting sold. And you can plan it all out. So yeah, I would say this is definitely a lot more of an advanced feature. You can also do custom here. What happens if I go to 0, right? All these sorts of shenanigans. Then if you had 0 income here with buying all of these, that would be a problem. That was something probably not likely you would do. But if you would buy 2, if you'd buy 1, different story, right? So this is that property feature or portfolio feature. Okay, now we are back here. Let's see what else I wanted to speak about. Real estate. You know, a lot of people always talk about this passive income. If you've been on social media, you know, there's a lot of people that's like, oh yeah, get your passive income to whatever, so you never have to work again. And although real estate seems to be passive, it has to be said that it's hands off is not no hands, right? Is what I like to say. There is still things to do. And you're not completely hands off, even with a property management company. At the end of the day, in my opinion, you want to be involved in choosing the tenant to some degree. You want to also, or you have to, for some decisions, be there as the legal owner of the property. And you have to manage it if your personal situation changes, right? If you, whatever it is, right? If you have some sort of, if you want to leave Germany, like what happens? Like you actually need to work with these scenarios. So just one thing for me. And then it's sort of like, hey, you're at the stage now, I want to actually buy it. Like it is a long process. It's not something, it's not as easy as signing up to Trade Republic or Scalable Capital and just like buy ETFs. And within, I don't know, how long does the account creation take? It's probably instant, right? Or like review it for 30 minutes and then boom, you can in theory transfer money and there you go. It is not that simple. This is something that I've built once. It's a rough guideline, right? But I want to visualize that you should spend as much time as you need to really understand the property, right? So this is like week 1, week 2. We've seen it. It can be 2 weeks, after you meet us, or maybe you have been evaluating by yourself for some time, and you just like sort of like just need to drop all of your final questions and maybe just need to find the right property, and find us, and then there you go. Um, but there is some sort of like financing thing in play, right? The way we work with our partners is that our partners actually take care of the financing as well, because they have the relationships to the banks, and the banks already know the projects, which is so much more valuable than trying to take a random property that you find on ImmoScout, go to random banks and ask for financing. It will be much more painful and likely result in higher equity needs. That's just our experience. So that's why we go for that model. There is some time that you also need to um, get the purchase contract. You need to review it. You need to be fine with it. You need to actually go to the notary. Then there is stuff that you need to do when as soon as the contract signed. There is a lot of things for you to do, a lot of on your plate. There's invoices coming. The Finanzamt wants their transfer tax. There is the bank wants you to open the bank account, the new one, to transfer the money. You need to transfer the money to the seller, like all of this sort of stuff. And then there is the final, like when you actually get the legal registration, can also take a while, right? Um, this is very stretchable. Sometimes this can take, like this last part here, sometimes can take 4 to 8 weeks alone. Yeah. So this is maybe a bit too over illustrative, but yeah, that's just to. All right, I think that was it for today for this masterclass. I think we went through a lot of different topics. Some last words from my side is that this whole sort of investing into property is just very different from making an emotional uh, uh, um, or sort of like buying your home that you want to live in, right? It's another takeaway maybe for the end here. You're buying numbers at the end of the day. It's you're also not buying ETFs for how beautiful they are named, right? They have the most cryptic names ever sometimes. Um, so it's really about the numbers when it comes to your property. They need to make sense for your personal situation, for your future plans. And this is where a lot of Excel templates or ChatGPT cloud conversations fail. um, and you need like a proper calculation hub where you can do that. And that's really what it's about. I hope you learned a lot. And if you are interested in this topic, we have everything that I just showed you is for free. So you can just try it out. And yeah, I hope we can inspire more people to think about their finances more holistically in terms of reducing their taxes and thinking about their investments in the same bucket, because there is opportunities to do so. And any questions, let me know. Bye.